Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take those opinions, form your own financial opinions, and make your own financial decisions. Today is Thursday, July 21st, 2022, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and we want to take a look this week in the world of crypto and kind of start peeking under the rocks to see what kind of dirt is under there. But before we hop to this week's content, I want to give a shout out to our Discord, link in the description below. You can find a link there. You can hop in. It's free to join. You can say hello to myself, Viper, a few of the other Blockhead traders. Love to hear what you're trading. Love to hear the type of content you want to hear about. But let's hop to this week's content of underneath that crypto rock. And Viper, I really want to kind of visit this just because the world out there is really starting to hear and see a lot of stories about crypto that are, I'll say, less than glamorous. And this could all be part of the media marketing of the downfall of crypto, and crypto is the end. Because you've heard us kind of in recent episodes call out, yep, we must be near the bottom because the whole world has their pitchforks and torches out for crypto. But as you and I both have kind of chatted offline before, sometimes we worry that we paint too rosy of a picture in crypto land, and it's really not. And so we feel we have to do a little bit of due diligence here to kind of balance the yin and the yang without, scaring everybody away, because there's value, there's opportunity there, but this is not a beginner's playground. There is danger abound. And I would even say there's slightly more danger in the crypto world than in some of the other financial instruments and vehicles that are more well established.
Yeah, absolutely. And this is, we're gonna try to keep this structured, but at the end of the day, there's kind of several key things that I want to unravel as we go through this. Which everything you said, absolutely. We really don't want things to be too rosy when we get all happy talking about our chickens and our roosters and whatnot. Like, you don't just walk into this space and say, that looks good, I'm going to try that. Like, I mean, there's a lot to it. And what I want to unravel is, like you said, I'm pretty sure anybody watching this, you're obviously in some form of money market, and therefore you absolutely have been bombarded with death of crypto and all of that stuff. What I want to do is unpack that. And what are they talking? Wow, maybe like it does go to the idea that things can get over sensationalized. However, I do believe there is a seed of truth to that starts all of this. Every story you've seen, there is an honest criticism in there, which we need to call out and make sure we put the light on that, because it's an unregulated world, and the crypto world. And so there's a lot we can learn about this moment, about why regulation is important, and get through some of those stories. But I also want to, I don't like it. It's going to sound like defend crypto, but I want to be realistic about why are these massive houses of cards falling, and does it invalidate blockchain technology, what it's doing, and what on-chain DeFi, decentralized finance protocols are doing? Does it invalidate all of that? Or, what is the disconnect here about these things that are just burning? I mean, just exploding. Like you said, we're going to lift the rock. I mean, the rock has been shattered. But at the same time, there's some things that I think are very good for the defense of crypto when you get onto a chain and you're not trusting some institution. But like I said, we'll see how it goes. We're going to try to keep it structured, but there's a lot to dig into.
Yeah, before I pull up the very first story that I want to talk about, I kind of want to equate this to a past time in history. As you know, we try to always look back at things, and Viper kind of said, "Look, just because you see all this out there doesn't mean like the underlying crypto is trash and should be thrown away." So I'd remind you of the .com bubble, right? The .com bubble was tech companies, e-companies, all this stuff, just super, super high valuation, absolutely poof, vanished overnight. The market crashed. But fundamentally, the internet wasn't bad. The technology that was building underlying there was still good. It still rose. And look at the e-commerce today. Look at the tech companies today. It just was an overinflated value, and I think that can be similar in crypto circles today. Is it's overhyped, overvalued. Doesn't mean the underlying technology is vaporware or evil. Just means buyer beware.
Yep, absolutely. So what's up first?
So the first story, this is like the appetizer, and the reason I kind of call it an appetizer is it's not really kind of the crypto related stuff. I mean, it is crypto related, but you'll see what I mean. So today, actually, in the Wall Street Journal, there was an article that came out about a former Coinbase employee who got arrested by the feds at an airport with a one-way ticket to India. And the reason this is notable is because there's been a lot of various speculations and things like that where you get these small communities introducing new coins, new things like that into the crypto world. And you've seen Viper track the price action on new intros, and they go to the moon as soon as they're introduced. And the sooner you can get in, you might catch that initial rocket. You can bail, parachute gracefully to the ground. Viper talked about all these, trying to sense them before they go. Well, these guys in Coinbase had an inside scoop. And so the one guy was a program manager, offering manager within Coinbase. And so he knew the schedule of what coins were going to be introduced on what days and what times on the Coinbase platform. And he basically leaked that information to his brother, probably several other people, and they would load up tens of thousands of millions of these coins that were about to go live on Coinbase before anybody knew about them. The absolute definition of insider trading. Nothing sneaky with crypto here. This could have easily happened with any large company, IPO, things like that. So nothing dangerous here per se to the consumer. It's just kind of one of these things like where there's money, there's going to be corruption. There's going to be these things. And so this is notable because it's the first time ever that somebody connected to these exchanges has been charged by the feds with insider trading. So the next story I want to bring up, and this is really going to start getting into more of the crypto specific things. So this was an article that came out just yesterday in the Wall Street Journal talking about the market route shows the danger of margin lending in crypto. And the thing that that drew my attention to this, or at least that I want to call out here, was this particular user who was participating in the Celsius network. So that's a crypto market, a crypto company where you can kind of, go in, deposit money, and get particular returns, interest rates, things like that. But they also allow you to take margin loan or leverage loan. So you can kind of deposit money, you can borrow money from them so you can increase your bets in crypto. And the reason I want to call this out is because Eugene here deposited about 25 grand into the Celsius network, and he borrowed $4,000 from Celsius. So this is a way that he was able to get extra leverage, to make bigger bets, things like that. This is not unique to crypto. Margin exists everywhere in the trading world, the financial world. It's a very normal thing. The part that I want to call out, and this is where some of the vehicles and the companies and the processes, they're just really not mature. So he got into a margin call. And a margin call is really when any lender basically says, yeah, I'm getting kind of nervous about the money I loaned you, and you're kind of getting a little bit risky. So I'd like my money back now, please, because I want it back before anything bad happens. It's called a margin call. And what Eugene got hit with was the request to transfer a half a Bitcoin of collateral back of money into his account so he could get his $4,000 back. They said, look, if you don't do this, we're going to liquidate the money you borrowed from us and you're going to lose your collateral, which was $4,000. Well, the thing is a half a Bitcoin at the time was worth $10,000. So they were basically telling him he needed to deposit a little bit more than twice what he actually borrowed from them. He says that's nonsensical. I might as well just pay you my collateral back to get my collateral back. This doesn't make sense. And the other thing that's kind of a little bit hidden here is on June 12th, Celsius themselves, the company that he was working with, actually got into a little bit of trouble, and they actually froze all the deposits as well as transfers. And that's notable because he got his margin call on June 18th, which doesn't he couldn't do anything about anyway because the transactions were actually all suspended. So even if he wanted to do this nonsensical thing and deposit $10,000, the platform wasn't accepting any deposits. And so it's just this real wonky situation that I think really kind of highlights the immaturity of the businesses in crypto. Is these are very, very young, very inexperienced businesses, in my opinion, that are trying to be innovative, sure, but you kind of have to have processes and procedures for some of these things.
Yeah, and I think it's worth pointing out because essentially this is a margin call, and so because I happen to know you're quite familiar with such a thing recently, what does a I don't know what the word is, a legit margin call look like? Because like you said, the margin trading is a real thing. It's fine. So in the equities world, what happens when you get into a margin call? Does TD Ameritrade come pounding on your door for twice, 2.5 times your collateral?
No, not usually. It really depends on what you've done and how you need to get it right again. But usually what they're looking for is they never ask for more back than what you've borrowed from them. So it's usually, hey, you've got a few days to sort this out, depending on the type of margin call it is. Is it a TD margin call or is it a regulation margin call? But yeah, there is a balance, and there's formulas and stuff that they follow. So you kind of know what type of margin call is coming. When you hit it, you know exactly how much it is. But I've never been asked for anywhere even close to more than what I've paid. Even actually what I've paid, it's usually some fraction of it. Is you just kind of got to chip in a little bit more.
Yeah, and I'm taking some liberties because we don't know all the specifics. And like you said, there's varying degrees of severity of your margin call in equities, but at the very high level in this, so he has 25,000 in his account and he borrowed 4,000. So in the equities world, this is a pretty healthy ratio here. And if you get into what we'll call the lowest level severity margin call on TD Ameritrade and other lenders as well, or other brokers as well, they basically, like you said, they tell you, hey, you have 3 to 5 business days, 7 days, something like that. What we're going to do is we're not going to lock out all these assets or whatnot, but we're going to say you can only sell and, therefore settle up what you think you need to settle up. Like, we're not going to force you to close this one thing. Maybe you got a strategy going and you're not severely in margin call. So do what you got to do, but you got X number of days, settle up. You're in sell only mode. And that's how they kind of tie your hands a little bit, but still give you this flexibility to maneuver around and get out of this. They don't lock you down and say immediately right now, pay us over double what you got.
So one question you might kind of have, and this article is a pretty nice article talking about all the dangers of margin and how a lot of these companies were borrowing it and leveraging it. But this whole thing started, or at least some of the nonsense and craziness started right here on June 12th when Celsius said, hey, we're freezing all deposits and withdrawals. because that had nothing to do with Eugene or his loan that he borrowed, right? It was that service was seizing up, and why was it seizing up? This article goes on to talk about a few other crypto things. Voyager is a big company, and they were kind of folding up under insolvency. But most notably, the reason that Celsius, one of the reasons, so call it maybe 1,000 paper cuts, is Celsius, which is where Eugene had his money, started freezing up because they had given out loans to other people, and those other people were starting to default. And most notably here, there was a big company that is going to appear in some subsequent news story here called Three Arrows Capital. And Three Arrows Capital basically had an outstanding loan from Celsius for $40.5 million that basically went into default. And that was one of the things that helped contribute to Celsius's operations really seizing up into insolvency, which caused them to freeze all of their creditor deposits and all of their customer withdrawals. And so was kind of a cascading domino effect that started well before June 12th and Eugene. He just happened to be kind of one of those dominoes in that fall.
Yeah. So far before, it was actually early May when the first card came out of the house. It just happened to be like a foundation card, not off the top. And so we kind of mentioned this on previous episodes, I believe. I don't think we've fully dug into it, but it is way bigger of a story than we can do right now. But it is important to discuss. The thing that kind of kicks all of this off was the absolute collapse of a blockchain called Terra Luna. I guess at a very high level, the only thing we'll get into about the technical side of what Terra Luna is or was there's this ideology in crypto that there needs to be a fully decentralized stable coin. And so when we say stable coin, that's pegged to X price. Everything's usually in terms of US dollars, it's pegged to $1. And basically all this is like when you're in your broker trading stocks and whatnot, you reset, you buy and sell, and you reset everything in terms of US dollars. That's your stable retreat. Something doesn't exist. Well, many options exist in crypto world of a stable coin. And they're all backed in various different ways. Some of them are truly backed. Every one coin is $1 backed and things like that. And so the goal of Terra Luna, the entire goal of Terra Luna was we want to be the stable coin for all of crypto, and we're going to be backed by this big basket of assets from around the crypto universe. So backed by Ethereum, big bags of Bitcoin and Avalanche and stuff like that. So that's all we'll get into about that on the technical side. And so basically what happens is they built this system to algorithmically maintain their peg to $1. There was a fault in it where there was a weakness in it where if somebody had, I believe it was close to $1 billion, they could kind of kick the machine and throw it out of kilter. And once it got out of kilter, then things started to collapse. Margin became involved. Long story short, we should do an episode on what happened, but it collapsed and margin was involved. And what we're looking at here is one of my favorite websites to track the world of DeFi, which is DeFi Llama. So this just goes out into crypto, and every DeFi, decentralized finance protocol, is tracked here. And we can see this. This is total locked up value in all these protocols combined. You can see we peaked somewhere around $252 billion locked up across, if we scroll all of these different projects here, which are decentralized finance protocols. And then we see this cliff here, and this is the evaporation of the Terra Luna blockchain. And if we go just a little bit closer here, this next graph here shows percentage. So of 100% of all protocols, all blockchains. We're looking at blockchains. So of all blockchains, what percentage of the locked up value lives on each blockchain? And you can see Terra, it's now called Terra Classic. But you can see it was just an unbelievably huge player in locked up value. I mean, it was, Ethereum was holding its own of the majority, though its color is obviously this bottom color, and everything has been eating away at Ethereum's market share in this case. And Terra Luna at its peak was somewhere around 15% of the pie. And so in one fell swoop, we had 15% of the pie disappear. And that triggered just all sorts of problems across the board. Thus, this Three Arrows Capital thing. Three Arrows Capital was somebody that was going around taking these massive loans from all of these big players, Celsius, Voyager, on and on it goes. And they were taking that money and they were going and putting it into these different DeFi protocols, high yields, things like that. And one of the things that anybody with massive amounts of money was in Terra Luna because of its thesis of being stable, having this ridiculous, steady 20% APY return rate just for holding and staking it. So if you had millions of dollars, you had money in Luna because of this crazy APY. So that all evaporated. Three Arrows Capital loses all of this money that they've borrowed from other people. And these other people they borrowed money from have some assets tied up in Terra Luna. So they're all taking the hit at the same exact time. And that's when they start going around saying, uh-oh, we're in trouble. We need to go call uncle on a lot of these loans and get this money back to save ourselves. And that's where things like the $40.5 million Celsius went to call back. Voyager, I believe, was hit even harder at somewhere around $650 million that Three Arrows Capital defaulted on them. So that was another one here worth talking about. Now I want to take slightly different approach to how we're framing this. So Voyager is another one. It's locked up right now. It's in bankruptcy court, just like Celsius. Anybody who had money in Voyager is locked out. They can't get their funds. And there are a lot of people that were blindsided by this. And they had a lot of money in Voyager because it was so consumer friendly. It was, I would equate this. I used it briefly. And we'll get into in just a minute why I decided not to keep using it. But I used it because I saw everybody using it. I mean, like any crypto YouTuber, anybody anywhere, like they treated this like their main brokerage in stocks. Or I equate it to like a Robinhood equivalent where it was just so user friendly. Open up the app, set up an account, transfer money, all that stuff. Just very, very sleek, polished, well done. And that builds this sense of trust of like, well, clearly this is too big to fail kind of thing. And so there's tons of money locked up in here. One YouTube channel that I watch, he has, I think his report, he said somewhere around, I guess he didn't give an exact number, but it was in the ballpark of $200,000 or $300,000 that's just locked. Can't have it anymore. That was a significant portion of his portfolio. And it is what it is, I guess. But so one thing that also attracted people was, if we scroll down here, they did this thing where you could earn up to 12% annual rewards, beat your bank by earning top rewards each month on 39 digital assets with no lockups. A little cheeky. So this was, they had over 100 assets available to trade, and then a select few, like the big players, Ethereum, Bitcoin, all that kind of stuff, you could actually lock them up in the app via staking, is a word we've used a lot in the crypto sphere. And they would give you this this up to 12% annual reward. And I think you had to build your way up to 12%, but immediately you could get like 4 to 6%. And that's insanely attractive. I mean, this whole beat your bank by earning top rewards. That like your bank right now is I don't even know right now, but 0.25% maybe. So
If you're lucky.
if you're lucky. So this is very attractive. Highly polished company, highly polished product, this building sense of trust, and also you're going to give me this massive rewards or annual interest rate. But the problem, obviously, is this kind of goes to the idea of where is this benefit coming from? I mean, this is a question that goes into all aspects of finance life. Where are you getting this free money from? And obviously you can't tell. Like, I mean, the companies don't just make this kind of information regularly available. They say, don't worry, we're going to give you this percentage rate. Obviously, as we're learning, it came from them taking your assets and loaning them out in loans to other people, other, hedge funds or whatever, just massive groups that are then taking that and going and now starting this big giant pass the hot potato, and all kind of without you knowing. And now the end result of you got lured in, only to find out your money is gone. They can't pay you back. My experience with this, though, I did briefly get into the Voyager app. Everything very sleek. I mean, it was very comfortable to use. Part of the reason I didn't stick around long was, as we know in my journey here, I've been very adamant about being non-custodial with my funds. Like, non-custodial means I put money into crypto and I need to own it. I want to have ownership of that. After all, that's the kind of the giant ideology of crypto, is having this ownership of your asset. Every single one of these companies is not giving you that ownership. They are just replicating traditional finance institutions with all shackles of regulation removed, and then just promising you that they will have your money ready for you whenever you want, which is kind of a worst case scenario. And so when I used the Voyager app, I noticed a couple things. I obviously, no surprise to anybody, very big on the Avalanche network. The first thing I did is I was like, I want to buy some AVAX on here. So I bought it. Other exchanges that I've bought AVAX on, Coinbase or anything like that, I can always escape. I can always take that AVAX. I don't have to settle it up to cash or a stable coin or anything like that. I can always just transfer it directly to my non-custodial wallet. Again, picture that as my wallet in my pocket. And what I noticed on Voyager is you could transfer directly to a non-custodial wallet, but only on a very limited number of blockchains, basically anything that runs on the Ethereum network. So Strike 1, I don't want to do that. I want to transfer on the Avalanche network. Strike 2, you couldn't even transfer Avalanche. Like not even a wrapped version or anything like that. And it was only like 4 or 5 different cryptos on the Ethereum network that you could transfer, which meant any AVAX I bought on here, I would have to settle it to something else, transfer it out. And it was just a big mess. And I felt it was like the first time I kind of felt closed in, where I was like, this is too confining. This is supposed to be my money and I just want to use it or send it or do whatever I want with it. And that's when I realized that these services, these apps are just not what I'm looking for when it comes to crypto and ownership. And so I can't say in a million years that I predicted something as massive as this, but at the same time, it was a little bit of that seed of this doesn't feel right. I don't have ownership of this. And in the number one guiding rule in all of my crypto experience is be as close to your ownership as possible and be prepared to lose it all. So giving somebody else the keys and then being prepared to lose it all was too much relinquishment on my part.
Yeah, it's a really important point to call out is that ownership, because when you get into the stock market, when you get into other financial vehicles, you still have a lot of that ownership. And if you don't have that ownership, like maybe in the case of a financial institution, something like that, where you're depositing funds in there, you have FDIC, you have regulation protecting them, you have terms, you have agreements, you have legal hooks, which are kind of secondary, second best things to that ownership. And if we take a look, none of these companies hide this. None of these, Celsius, Voyager, none of them are hiding Coinbase. None of them are hiding the fact that these are not your assets. I'm pulling up an article here. This is about the Celsius network that went bankrupt, and the leader of the company was talking about it. And there's a lot of speculation that some of these people might never see a dime of their money, because very explicitly in the contract that the users signed when they deposited funds into Celsius is the company has ownership rights over the deposits, as well as the right to lend, sell, transfer, or use them for any period of time. You're essentially forfeiting all of your control over those assets on the promise that they're going to deliver this interest rate to you, but really no guarantees whatsoever. And so I think that's a very important thing to call out. Like, everybody laughs and just clicks through all those EULAs and agreements and things like that, but they're there for a reason. Pay attention to them.
Yeah, absolutely. So what are we to take away from all of this? Are we just, so the whole thing is just bad? The whole thing's a joke. There's no way to get, good interest rates, possibly better than the bank. I would state no. That's not what we're supposed to take away from this. All we're taking away is, like I said, the fact that we had corporations or just companies trying to operate like I said, I'm just repeating myself, traditional finance with all shackles of regulation removed. I guess I shouldn't say all shackles. Like, Coinbase is still somewhat regulated because they are a publicly traded company. But for the most part, nothing is regulated like TD Ameritrade or being FDIC insured and all that kind of stuff. So I want to call out a bright spot of, what does good DeFi protocol look like? And this still doesn't mean that this is bulletproof. Don't think that, I'm going to talk about this thing called Aave, and so you should just run to Aave and use Aave. That's not what this is about, but this is I want to showcase some things that what make this much different than, let's just keep running with Voyager. So Voyager offers you this interest rate that's a fixed interest rate. So let's focus on earn interest and borrow assets, because that's obviously the most similar thing to what we just talked about with Celsius. They said, give us your money, earn interest. You can also borrow assets. So this sounds like the same exact thing. This sounds like we're just waiting for this shoe to drop. But what I love about Aave is this is an on-chain protocol. This is a DAO of sorts, a decentralized autonomous organization, where there is no company making these decisions. In the case of Celsius, Celsius was determining who to lend money to, or Celsius was determining what percent could they afford to pay you for your assets to them. And they wanted to make it attractive. So there was a bit of marketing involved of like, hey, people like 6 to 12%, like, we're going to fix it somewhere around there. So in the case of Aave, this is not the case. This is all programmed. This is all smart contract based, which means when you deposit your funds here for someone else to borrow, there's an entire program that is generated to execute on certain conditions, and everything is known ahead of time. It's almost like if you did something, a business deal with a contract, and it was the easiest contract in the world to read. Instead of 500 pages EULA, it's like 2 pages, dink, dink, dink. Everything makes sense, and everything's going to happen. So what does this look like when we go into here? So basically, what we're looking at here is if you came into here and said, I have a bunch of Avalanche tokens, I want to deposit it, I want you to give me an interest rate. for giving you my funds. And so in this particular case, they're going to give you 0.23%. So first of all, you're thinking, well, that's okay. That's not nearly as attractive as Voyager's 6%. Well, I mean, there's a little small light bulb there. Maybe there's a reason it's not as attractive. Maybe it's not affordable to give you 6%. And what we're going to go into real quick is this fluctuates. This is a variable interest rate, and it varies depending on how affordable or how capable the protocol is at paying you that rate. And so this goes to the whole know where your money's coming from. So if we go down here, what is happening? Well, this is a big pool of Avalanche tokens. So currently the pool size is $11.06 million big. Currently, only 13.08% of that pool is being borrowed. So that means there is 9.62 million of the pool available for anybody to come in and borrow. And so the first question I had when I got into this was, okay, so they borrow it. What happens if they don't come back? Well, in this case, you have to take an over-collateralized loan. So to borrow $100, you have to put up $150 of something else. Reasons for that, there's a whole bunch of strategies we could get into, but suffice it to say, legitimately, there's good reason to come in and put in an over-collateralized loan. Now that protects me, the supplier, because there is now more value locked up on the borrower's side than on my side. So if they never come back, that can be liquidated and triggered. I still get my value back. We're all good. And now the variable rate, we can see today, if you came in as a borrower, you would actually be borrowing at a 2.06% rate. So already we can see immediately how this 0.23% can be afforded. It can be afforded because the borrower is paying 2.06%. So give me 2.23%. That makes sense. So finally down here at the bottom is their interest rate model. And this is this just shows how the interest rate varies over time. We can see the utilization rate and the variable interest rate at that utilization. So currently we're down here at 13. This is the borrower rate. The borrower is borrowing at 2.1%. And as we can see, as pool utilization goes up, so as more of this pool is loaned out, the variable interest rate continues to go up. And at one point here, they call optimal, all of a sudden, the interest rate skyrockets. And this is done for a couple of reasons. They outline everything in their white paper. But namely, it starts to become more risky. It starts to become, we'll say more risky for the supplier to be able to withdraw whatever they're supplying once we get over 50%, because now we're over 50% utilized, which means if everybody in the pool supplying said, I want to take my money back, we're going to run into a problem where not everybody can get their money back. And so to compensate them for putting their money in here in this high utilization scenario, they start to charge the borrower more interest rate, which then incentivizes the borrower not to hold this forever. I mean, we get all the way up here at 90% utilization, and the borrower is paying 255% on this loan, which means they better be really quick. Whatever you're using this for, go strike real quick, bring it back, because if you hold that, this is a crazy interest rate to pay for any loan, and that is reflected in their over collateralization. So they will be over collateralized in a way that will be eaten away to ensure me, the supplier, that I still get my value back. And I guess in the end, to summarize it, as I'm the supplier on my dashboard, if you're a borrower, on your dashboard, it actually gives you a little timeline of how long you can hold that money before you run out of collateral and you get liquidated. They're not going to wait. That it's going to count down. They're going to say, you know what, you're too close to defaulting on this loan. So if you don't return it by this marker, you're done. We're liquidating you, and we're going to go give the suppliers their money back. So at the end of the day, I highly enjoyed this Aave protocol, a lot for its transparency, but also because it is what I believe decentralized finance should look like. And it is not run by, a a company that can make these behind the scenes decisions about my money, I can enter into these contracts knowing exactly what's going to happen to my money, which thus keeps me at least a little more protected. But again, I don't want to paint this as super bulletproof, but just the comparison between Voyager Celsius and something like this, which is a good example of on-chain usage.
Absolutely. I think the key takeaway here is to really understand how your returns are coming. You know, no matter what your investment is, whether it's an equity, crypto pool, DAO, an organization, how does it work? Where is it coming from? What is the fund? Know all of that stuff is so important, because understanding how something is will help you uncover if something could be too good to be true. It will help you uncover, does this make sense? Does it check out? Don't get duped by big numbers, rosy pictures. Everybody else is doing it, so everybody can't be wrong.
Yeah, I think my final thoughts on everything we've discussed is nothing is too big to fail. Nothing should appear too big to fail. Like I said, with the Voyager thing and everything so polished, surely this thing they've got it together. And for all of that, I mean, that's where, when I kind of at the very outset said there were these seeds of truth in all the media articles, anything as dramatic as it sounds, you can't trust crypto or any of that. The seed of truth is the fact that you have these players who are trying to provide these traditional finance services, again, like I said, without any regulation. That is problematic. That is not sustainable. And to me, that is also not the goal of crypto. I think what we have right now is this period of time where we have an underlying technology which is very revolutionary in its design and what it can enable. But the problem right now is there is that lack of regulation, and so we have players that are playing with this system that are just running amok. And hey, you mean I can do this and nobody's going to stop me? That phrase right there, I can do this and nobody's going to stop me. That needs to be resolved. And I feel like that's my most optimistic view of this current moment is we have this moment where these things are collapsing. Massive billions of dollars are just evaporating out of here as these massive companies that shouldn't have been doing what they were doing are evaporating and flushing out of the space. What I would like to see is now is the moment to get some consumer protections and regulations in here, because now is the reset. Now is when all this stuff is cleaning out. Don't know if that's going to happen. But there are some warming ups to the idea. I know on my side, there was somebody that I talked to in the crypto space that actually attended an SEC. The SEC came to this crypto event and just held an open talk. And basically, the main takeaway I thought was the most interesting was they admitted that the SEC is running very slow. They are traditionally a very slow regulatory body. And that's definitely the case when it comes to blockchain assets. However, one of their arguments to defend that slowness was they don't want to move too fast and stifle innovation in such a technologically focused space. And so, but at the same time, they do acknowledge that consumer protections are very much needed. And so that is the yin and the yang and the balance that they're actively trying to navigate. Suffice it to say, I hope in the wake of this that it's now screaming. Consumer protection is desperately needed.
Never waste a crisis. I am sure that the politicians and everybody will strike at this, but I agree with you. It's absolutely needed. I'll draw just a brief attention. There was a large pension fund in Canada that had invested seed money into Celsius, not giving them money to reloan, but they were actually funding the company Celsius. And the key thing there is they were a pension fund for a bunch of Canadian workers. And a pension fund, it needs to be stable. It needs to make smart investments. And, they got into a little bit of hot water. And not that long ago, a lot of people were really screaming at the head of the SEC, Gary Gensler, and his stark, strong stance that they do not want certain crypto-based ETFs. I think it was a Bitcoin spot price ETF out there to be on the market yet, when the regulation is so Spartan in crypto. And at first, people were like, "What the heck? You just don't want to see it succeed. You're big money, big banks, whatever." But think about this pension. What happens when you see those products traded is it gives those products a certain set of legitimacy. It is kind of the green light to the casual layman person saving for retirement, company doing that stuff. And you absolutely always need to do your due diligence, but it's a little bit irresponsible, in my opinion, to throw some of this stuff out there in that format to the larger public when it's not real. There's no real controls over there. It's financial institutions with no shackles, as Viper had mentioned earlier. Yeah. And so keeping that in mind is super important. I can't imagine if some of this stuff was backed by the SEC and allowed to trade, how many more people could have gotten, seriously impacted by the fallout from this.
Yeah. And the last thing I'll tack onto that is it's more than just the price action. So if this spot ETF had been approved and whatnot, it's not just the fact that value drops so quickly. It's this insolvency risk of not having that regulation and that backing. That where's that ETF putting that money? Maybe that ETF, in the best of intentions, went and put it into Celsius or Coinbase. I mean, Coinbase hasn't gone down yet, but still, it's that function of it as well. Of it's not just the price action being dramatically damaging to that investment, it's the insolvency risk, which is pretty large right now.
And that's really where your long-term repercussions come from. I mean, that was the premise of the whole housing market crash and the financial crisis of 2008, is those banks were on the borderline of absolute insolvency. And that being solvent was the backbone of the way money moved in our world. And so absolutely, that's why there's regulation out there. It was a lot of insolvency caused the 1929 stock market crash and the Great Depression and the run on the banks back then. So there's a history of this insolvency being very, very dangerous. That brings us to the end of this episode. Really just kind of wanted to pull up the rock and look at some of the underpinnings there, that recent news in the crypto world and stuff like that. So hope you kind of enjoyed that a little bit. If you didn't, leave a comment, let us know. If you did like it, leave a comment, let us know. Drop in the Discord, say hello. Otherwise, the market has really been turning. Things are starting to get exciting. My account's starting to come back alive again. I'm starting to be a little bit more liquid. And so it's a pretty awesome time right now and getting better. So good luck out there in this week's trading. And remember, think outside the block.